With the S&P 500 recently clearing some important technical levels, and with the situation in Europe having calmed down, at least temporarily. In this video, we will provide updates on the status of 3 of our market models, DeMark counts, revisit some bull versus bear bullet points, and put some historical context around a recent and potentially bullish development in financial stocks. These are some bullet points that we originally discussed in February of 2012. Let's just revisit them and update what was at the time somewhat of a battle taking place between longer-term bullish factors and shorter-term concerns that we had. At the time in February, we mentioned that the unprecedented expansion or money printing via the ECB and the expansion of their balance sheet was leaning bullish, and that the majority of our mathematical, technical, and probabilistic models were also moving to or already in the bullish camp. We had on the bearish side of the ledger some concerns about DeMark count setups, and let's talk a little bit about where we are with the DeMark counts on the S&P 500. We had a DeMark risk level formally exceeded or broken at 1343 on the S&P 500, and a DeMark risk level is a lot like a stop loss level, and when it's formally taken out, it still gives us good information, as we've mentioned in the past, in that the strength of an underlying trend has to be strong or very strong to negate the DeMark setup. So when we had the break at 1343, that actually gave us a bullish signal. Currently, we still have DeMark counts tied to 1364 and 1377 on the S&P 500 that have not been formally taken out based on some pretty complex DeMark rules. However, as of Wednesday's close, we've traded over 1364 at some point for 13 trading days, and we've traded over 1377 for 2 days. And typically what you'll find with DeMark exhaustion counts, when they're good signals, the market will never even reach those levels. It can come very, very close, but it typically doesn't trade at those levels. So the fact that we've reached them and breached them probably says that even though the counts at 1364 and 1377 haven't formally been extinguished by DeMark rules, it's looking less and less likely that those signals will be good signals. And again, that gives us good information. It tells us that the bias will probably continue to be on the bullish end of the spectrum, and relative to the battle between money printing here and our market models versus the DeMark exhaustion counts, it appears that these bullet points up here are ruling the day. We also avoided the wild card of a hard default. In Greece, we had what the market would call a controlled default, and as we'll show next, that's a positive fundamental development in Europe, at least for the short to intermediate term. They were able, with the money printing, to kick the can down the road again. We've also had some important technical improvements, or tests that we've passed recently or appear to have passed in Europe. Since the current crisis or existing crisis originated in Europe, and since Germany holds the purse strings in Europe, the German DAX, which is very, very similar to the EWG German ETF, is really an excellent way from a technical perspective to monitor risk in all markets. And reviewing this chart, you'll see first that in terms of opportunity that may be left on the table, there's still potentially a lot out there. And why is that? Well, Germany is now retesting basically a breakout relative to this high. And the point in terms of what potentially could be left on the table on the upside, as far as Europe and Germany goes, if you bought roughly at these levels, or today, you're in the exact same spot as somebody that bought 4.5 months ago. So there's been a long period of consolidation, and in terms of opportunity, somebody that bought 4.5 months ago has just gone through this period of consolidation and has roughly came in at the same levels as somebody that came in the last month and a half or so. The bullish developments here are that you've got this consolidation period, a breakout. Now we've come back and tested the breakout numerous times, and maybe more importantly, this red line here is the 200-day moving average. And the most important thing here probably is that notice price has touched the 200-day moving average several times now. And the more a market touches a trend line or a moving average, the more important it becomes. So this is now pretty firm support in here. And notice we came back and retested this, which is another reason why, in terms of stepping in front of risk and stepping in front of these markets, that some patience was warranted. Because if you know markets and technical analysis, the odds were pretty good that we were going to see a retest. We recently have seen the retest. Roughly it occurred about a week ago, and it appears that we're going to pass. Now, from a technical perspective, you could maybe make one more argument that some patience is in order, and that would be that you could say that this is a head and shoulders topping pattern that's still potentially in existence, and this would be the left shoulder, this would be the head, and we'd be making the right shoulder here. Given the big picture weight of evidence, I'd say the odds of this being a head and shoulders pattern now are relatively small, probably under 10%. What needs to happen to negate that possibility, the door is still open. EWG or the DAX needs to make a new high relative to these highs. And our guess would be that that's going to happen within days, if not within some time in the next couple of weeks. Another bullish development would be that you've got the 50-day moving average, this blue line here, crossing the 200-day. That's what's known as a golden cross. We've seen this already in numerous markets. But again, given the weight of the evidence that we have now, and that we've got some type of quote-unquote resolution or can kicking that's taken place in Europe, this golden cross is probably, from a probabilistic standpoint, going to be a good golden cross, which is bullish not only for Germany, but for all risk assets. We've got this base here. We're still near the top of the base, which says potentially there's quite a bit of opportunity left on the table. So quickly here, to recap, we're revisiting bullet points that we went over again in February. These were the bullish points. All of these bullets here from a bullish perspective remain intact. Here are some of the potentially bearish concerns that we had. We talked about DeMark. Looks like we're in pretty good shape there, although there are still some longer-term concerns there. The global technicals, as we just noted, have improved. We've got some resolution in Greece. Portugal bonds and Italian bonds are acting fairly well. And we had some concerns about slowing growth in the U.S. and Europe. Some competing bullets here. Europe is going to go into a recession, if not already in a recession. That's still somewhat of a bearish wild card. In the U.S., we continue to get pretty good economic data. So the weight of the evidence seems to be shifting, at least in the short to the intermediate term, to this side of the ledger. We also understand that since we got over here, based primarily upon papering over debt problems in Europe, that we could end up back on this side in relatively short order, which speaks to flexibility. And that's one reason why we have and are continue to make changes to our models in terms of tweaking them to be a little bit more sensitive to market conditions, which tend to either go straight up or straight down. Earlier in this video, we showed that Germany appears to have recently passed a technical test. This looks very complex. It's not what we've got here. The concepts are very easy. This is XLF, which is financial stocks, the ETF, relative to the S&P 500, or SPY, which is the S&P 500 ETF. So you're looking at the relative performance of financial stocks to the general market. So financial stocks are weak here, strong here, etc. Here are the takeaways. These lines here, the colored lines, thin colored lines, are shorter term moving averages, 10, 20, 30, and 40 day. This is the 200-day moving average. What these moving averages do is they smooth out this volatility and they allow us to somewhat see the underlying trends. Trend is down, shorter term trend up, down, up. The 200-day smooths out the bumps in a much more longer term manner. So what we've got here is a breakout. This is financial stocks relative to the S&P 500. Note here that we've got the intersection of the shorter term moving averages that are forming kind of a tight cluster here with the longer term moving average. This is significant resistance and a test here for financial stocks. If this fails, much like if Germany failed, then the whole rally off of the October and December lows could have faded, and it still may. If this comes back and fails this test, that's a huge red flag for risk, and the same can be said for Germany. If Germany rolls over and moves back below its 200-day moving average, that's a big red flag for risk. However, as of this video and as of Wednesday's close on the 14th, the tests appear to be being passed in a bullish manner. So when we have this breakout here, now what was strong resistance here becomes support. So this is bullish for financial stocks and bullish for the market in general. We've had similar quote-unquote breakouts here that were bullish for the market. This is late December. You'll notice that financial stocks relative to the S&P 500 broke above these shorter-term moving averages. The S&P 500 did well here too. We've got a bullish MACD cross on this ratio. Here's a cross, bullish implications, crosses here. So this is a bullish development. You've also got the MACD histogram ticking up. This too could fail, but all things being equal, this is bullish. This is the relative strength index for this ratio of financial stocks to the S&P 500. A bear market from RSI tends to look like this. You tend to stay in the lower half of these bands and you don't get up into this white space here. A bull market is a mirror image of that. You have a tendency to stay in the upper band and you don't visit these areas down here that you do in a bear market. So the point is that since December, financial stocks are beginning to look like they're in a longer term bullish stance relative to where they were before. You also had Williams %R, which is a momentum indicator. Notice here the momentum indicator can't get to this upper band on rallies. That tells you that these rallies will probably fail, which they did. We have just the opposite now. This momentum indicator on corrections has not reached the -80 level, which tells you that these rallies will probably be sustainable. What we're doing here is we're putting the recent move in financial stocks relative to the S&P 500 in some historical context. This is basically 2009. Here's 2010. We had a similar situation looking at the ratio of financials to the S&P 500. You've got a cluster of the shorter-term moving averages in a tight cluster intersecting with the longer-term 200-day moving average here, and we had a bullish breakout. So the present day looks very similar to where this cursor is now, roughly about right here. So what happened next? This is the S&P 500. After this breakout, the S&P 500 moved from here to here, which is about a 17% gain in 6 months, which again speaks to the we've missed an opportunity question. There could still be a lot of opportunity left in this market. I'll caveat that with if this breakout fails, then there could be a lot of risk in this market. So by no means, there's no such thing as an all-clear signal in any market, but especially in the world that we live in today where central bank influence government intervention and printed money are keeping things propped up, there's never an all clear signal in these markets. All you get are degrees of risk. So when we get these type of breakouts, the downside risk has been minimized somewhat, but not removed. If we move down this way in the present day, that's a big red flag. How did the financials do after this breakout here? From this point here to this peak here, XLF gained an additional 30% in roughly 3 months. So some opportunity may be on the table if this breakout holds. The S&P 500 gained 17% in the next 6 months after this breakout. So that doesn't include any of these gains or any of these gains. So 30% here, 17% here over the next 6 months. We have no idea what the future holds. All we know is we've got money printing again, and we've got a similar setup here that says the odds probably favor higher highs in the S&P 500 and higher highs in financials. If this fails, it also gives us good information that the entire market could come back under pressure. This is a chart of the S&P 500, a monthly chart that we've looked at in the past. First, let's talk about short-term, intermediate-term bullish developments. As we've talked about in the past, the black line is price, the red line is a moving average, the blue line is a longer-term moving average. Bullish conditions are black and red above blue tends to be bullish. Bearish is black and red below blue. So this is what bullish conditions look like. This is what bearish conditions look like. We get the cross here, bullish, cross here, bearish, cross here, bullish. A key takeaway here, and what may explain why so many money managers and hedge funds underperformed last year, is somewhat encapsulated in this chart. You'll find if you've worked on Wall Street for a long time, there's some common themes in this chart. Here's a bottom here. This stems from problems in Asia in 1997 that spread eventually to Russia and Brazil in 1998. And the Fed printed a ton of money here, and the market went up. We had a bear market here, dot-com bust. We came down here, the Fed lowered interest rates to historic lows, which basically means they printed money and created a bull market and a bubble in housing. Then we had the housing bust. Come down here. Here's the common theme. Bottom, money printing. Bottom, lowering interest rates and money printing. Down here, TARP, QE1, money printing. Here's where things start to change. Come in here, here's QE1, here's QE2, bottom, money printing. Here's where the European Central Bank offered the unlimited and unprecedented amount of loans in the form of 3-year loans to banks in Europe. The point is, notice the frequency of government intervention. Look how far apart these two major interventions are and how close these are. We've gotten to a point where central bankers know that the balance sheets are so impaired and things are so propped up that they're afraid to let asset prices fall. So you've got roughly now about once a year, we get major intervention into the markets, intervention. And this is why it's become so much more difficult to manage things from a longer term perspective. If you have models that are built on multiple year cycles, and now you're getting to a point, instead of going up for several years and coming down for several years, that now you're going up for several months and coming down for several months, up for several months, down for several months. So while we have a bullish cross here, this cross that we've recently received looks similar to holding in this period, crossing here and crossing here. Holding here, gains followed, cross, gains followed, cross, gains followed. We held, gains followed. Here we broke down and crossed, which is different than anything that's happened before. But what's really happening now is they just print money faster. That's what they've quote unquote learned. Timothy Geithner will tell you about the lessons that they've learned. Well, the lessons that Mr. Geithner has learned and passed on to people is that if you're going to print money, print it faster and do it early in a cycle to keep asset prices propped up. Another potentially bullish development, and something that we were concerned about, is you could also have made an argument that this was a head and shoulders pattern forming here. Left shoulder, big head, right shoulder. Well, that's been negated. You can't have a head and shoulders pattern when you exceed this high. So this is another potentially bullish development. One of the big takeaways is this may be a relatively short-lived bounce here. We don't know. Or could it be something more on the order of this, where the market went up for a few more years before coming down? Here's an update to a longer-term buy and sell signal table that we've used in the past. As you can see, there's a lot of green here now. This is similar to the chart of the S&P 500 that we showed with the red and blue and black lines with the moving average crossovers. These are some of the models that we use. We've got a lot more than this. This is just a handful of them. And as you can see, they've all migrated in the stock world, for the most part, to longer-term buy signals. Canadian stocks look like they're poised to go into a buy. They just haven't gotten over the hump yet. There are some weekly charts that look pretty good for Canadian stocks. It's the monthlies that are lagging a little bit. One thing that is different about this entire market, and potentially concerning, either one of two things is happening. Commodities are either going to take a back seat to stocks for a longer period of time in terms of cycles, which could be happening before they reassert some leadership, and that cycle could be as long as 3 to 6 years, or the fact that copper and silver have not yet been able to cross over and hold into bullish territory with these models is a yellow flag saying, hey, look, the economy is weak, and maybe these signals here are not going to be good signals. But with what we know right now, the trend seems to be bullish, and these are longer-term signals. We noted earlier that the markets tend to go up and down in shorter cycles, so the way to play this is, as long as this table remains green, then you err on the bullish end of the spectrum, but understand that things could reverse quickly. And as we noted earlier, we've made some changes and continue to make some tweaks to our models that'll give us signals earlier should this rally fall apart. We'll finish up here with a quick update on two of our other models. This is the CCM 80/20 Correction Index, which you can read about on our website. Here is the current reading on it. These are risk-reward ratios for the S&P 500. Green is good, red is bad. The point here, current level, we're still kind of in the meat of the curve. It tends to support the potential for further gains. This model can go higher before we run into trouble. And it should be noted, when you're down in these areas here and you're shifting from a bearish outlook to a bullish outlook, these models tend to be pretty volatile and can jump up and down. But once they get into this meat of the table here, they're not as volatile, and the numbers won't change as rapidly as they do down here, which speaks to the potential for further upside looking out 1 year, 9 months, 6 months, etc. This is an update to the CCM Bull Market Sustainability Index, affectionately known as the BMSI. Similar situation here. We're not showing you the whole table. This is just a portion of the table. Here's where we are as of Wednesday's close. And you'll note, looking out 9 months to a year, these numbers in this portion of the table here are still way, way above the average risk-reward profile for a bull market, which tells us that we've still got a lot of potentially on the table, with the caveat that things can change quickly. But this model also seems to support what we've seen recently with the retest in Germany and the breakout in financials. As far as sectors go, We like financials, technology. We like retail, and consumer discretionary is still stronger than consumer staples from a longer term perspective relative to our models, which also leans into the bullish camp. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shravaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.